Hello, it's a lovely good evening from here in Delhi, and as always, hope that each one of you are absolutely fine. So, now in this particular session, as you can see flashing on your screen, is Ind AS 8, and of course, it happens to be corresponding to International Accounting Standard 8, and of course, that means we are dealing today with accounting policies, changes in accounting estimates, and errors. Many a times, actually, it seems that these are the wordings which we are quite familiar with, isn't it or not? If you remember in your earlier phases of education, you have gone through already an accounting standard by the name of what we call AS5, correct? I'm talking about existing accounting standard. If you distinctly remember, actually, you came across such wordings over there also. However, to be very honest with you, this particular standard is not as easy as the existing accounting standard AS5. It's a pretty complicated standard, and it is very tough and very what we call important from the examination point of view. So all these means that you need to pay some extra attention towards this particular standard. So without wasting much time, let me come direct to the point. So I have already written that this Ind AS 8 or International Accounting Standard 8, of course, it means it deals with accounting policies, and besides that, it also deals with changes in accounting estimates and errors. So what exactly is the objective? You will have to write today only one page. In fact, I had written the entire pages, but the problem is that my first page somewhere I lost out. So only one page you will have to take the pain of writing. Otherwise, rest of the standard I will explain the things. But as usual, we are going to do lots of what we call case studies. Correct? So here we go and start with the objective as we normally do. So let me hold the red pen first, as you know. So point number one, objective. Correct? Let me actually just settle down the things a wee bit. Right, objective. This will give a good view. What exactly is the objective of this particular standard? Of course, this particular standard, I have already told you, prescribes the criteria for selection of accounting policies, and of course it will give some accounting treatment with respect to changes in accounting policies. Besides that, we will also see the accounting treatment and disclosures whenever there are changes in accounting estimates. And of course, we have already seen and we have already talked about prior period item under accounting standard AS5, and even in this particular standard we will talk about that also. So let me write the objective first. So objective is to prescribe. Objective is to prescribe. Objective is to prescribe the criteria. CRITERIA. Objective is to prescribe the criteria for selection. In fact, for selecting and changing accounting policies. That means whenever an entity would decide to select an accounting policy, it will have to have a look over this particular standard, because this particular standard actually will provide some criteria for selection. Similarly, if the entity would decide to induct a change in the accounting policy, then again it will have to take the help of this particular accounting standard. So this will give you a clue actually how important this particular standard is. Correct? So to prescribe the criteria, I would write it this way: for selecting and changing the accounting policies. Similarly, for accounting treatment, accounting treatment and disclosure of changes in accounting policy. So besides, this particular standard will provide some guidelines with respect to the accounting treatment that whenever we are going to change the accounting policy, how we are going to account it, besides that what disclosures we need to furnish at that time. So these are the criteria which this particular standard provides. In fact, that is exactly the objective of this particular standard. As I said, besides what we call this particular standard also will deliver us some what we call criteria with respect to the accounting treatment and disclosure of changes in accounting estimates. Accounting treatment, once again you will have to write accounting treatment and disclosure of changes in accounting estimates. In accounting estimates, we will talk at length later on when we are going to pick up accounting estimates. Correct? Besides, this particular standard will provide some what we call criteria with respect to the accounting treatment and of course the disclosure of correction of errors. Correct? Accounting treatment and disclosure of correction of errors, because this particular standard deals with correction of errors also. Correct? We will see whenever we are going to correct an error which occurred in the prior period, then how we will have to account it. And it's not an easy task, to be very honest with you. This particular standard is not easy, as I have been telling right from the beginning itself. Just after having a scope, just for the sake of formality, we need to take into account the scope also. So I will simply write the scope. In fact, the scope and objective more or less are absolutely same, but still, as far as scope is concerned, every entity, because we have already seen all these things, that means whenever an entity is going to select and apply an accounting policy, it will have to take the help of Ind AS 8. That means that particular part will fall under the scope of Ind AS 8. So we will simply write here, standard applies, standard shall be applied, this standard shall be applied in A, selecting and applying accounting policies. Every entity, whenever it would select an accounting policy and apply, will have to what we could have a look over this particular standard. B, accounting, I have already told you it is similar to objective. Accounting for changes in accounting policies. So whenever you are going to incorporate any change in your accounting policy, you will have to have a look over this particular standard. Similarly, whenever you are going to change any estimates, changes in accounting estimates, and correction of errors, correction of errors, correct? So these are the things which you need to know. Correction of errors, or simply we can also write correction of prior period items. One and same thing, don't worry about that. Now we come to the important part, that means now we are beginning this particular standard. Right now we have come to the conclusion that this particular standard has got three main facets. One, accounting policy, second one, estimates, and third one is errors, isn't it? So first we begin with accounting policies. Now accounting policies, if you remember, you also studied under Ind AS 1. accounting policies. Policy, in simple words, means a set of rules or principle which you are going to apply to a particular transaction. But point here is that you simply cannot blindly put up a set of rules and principle towards a particular transaction. Whenever you are going to apply an accounting policy, you need to take care of that it is relevant and it is reliable. So that is why you need to have a look over the guidelines of the Ind AS. So as far as accounting policies are concerned, Ind AS 8 is very clear regarding that. It is going to give some direction regarding the selection and application. The first point is not telling how. It is simply telling that whenever you are going to select an accounting policy, let us say with respect to selection of FIFO method or weighted average method in case of valuation of inventory, similarly depreciation method, straight line method or written down value method with respect to depreciation. Correct? So that means because in accounts there are several alternatives available, we need to select a particular accounting policy. So this particular standard will simply provide some guidelines and direction to the entity whenever it is going to select an accounting policy with respect to the things as I just mentioned. So I'm simply going to write here Ind AS 8. Ind AS 8. I will write again. Ind AS 8 provides direction. It provides direction, correct, to the entity. It provides direction to the entity regarding selection and application. Of accounting policies. Such as, because more or less every entity has to confront several alternatives before it, and it has to select one such policy which is reliable, as I told you, and which is very, very relevant. Correct? So this particular standard will provide some guidelines. What are those guidelines? We'll talk about that later on, but right now the point here is that it provides some guidelines. So whenever an entity will select an accounting policy, such as A, whether the entity should go for cash system of accounting or accrual system of accounting, cash or accrual or hybrid system of accounting. B. Similarly, for example, entity will have to apply the accounting policy whenever it will have to decide what we call for a particular method of depreciation. So straight line method or written down value method of depreciation, isn't it? C, FIFO method or weighted average method. There are several methods. I have written only two. FIFO method, weighted average, standard identification, NIFO, HIFO, LIFO, whatever you want to write. FIFO or weighted average method of valuation of inventory. Because several alternatives are with us. That's the problem, and we have to select one such basis which provides reliable, relevant information. Method of valuation of inventory. Similarly, sometimes there is a dilemma, and entity and the management has to decide what we should include in cash and what we should not include in cash or cash equivalent. Correct? So I will write here what is included or what to be included. What is included in cash or cash equivalent. So there are several questions, correct? Similarly, an entity may face a dilemma exactly at what point of time we need to recognize the revenue, and for the same it will have to frame out some policy. When revenue to be recognized? When revenue should be recognized? So you can see actually as far as this particular standard is concerned, correct? This particular standard is very, very vital because it has got a great bearing on accounting policies. So this is my first sheet which I wrote. Now, good thing is that you need not require to write because I have already written. These are the notes. In fact, the first sheet also was there, but it got distorted. So now we move over to the second sheet. This is second sheet. Now we come over to this particular sheet. I will put up this particular sheet over there, correct? Because I received some favorable feedbacks regarding this particular methodology. So that is why I tried to adopt it. So after having a look over the objective and the scope, and of course various examples of accounting policy. Now my first question is, it looks simple question, but sometimes very difficult to give answer to. Is it compulsory to follow the accounting policy? Is it compulsory? Suppose if you have framed an accounting policy, or let us say a particular Ind AS has given some direction with respect to what we call policy to be adopted with respect to a particular transaction. So should as an entity, I need to follow that particular policy or not? So your answer sometime may appear that the answer should be yes, but the problem is that answer actually is no. No, policy need not be applied when we think that by what we call applying this particular policy, we may not be able to give a proper information, or when we think that it is immaterial, it is not quite significant. So it indirectly it means the answer is no. So that means it is not compulsory for us to adopt a particular policy. So no, policy need not be applied when the effect of applying them is insignificant, immaterial, correct? So you can say this is your question number 1 for simplicity's sake. Okay, I will not write the question, I will simply write it this way, otherwise it will get confusing. Then next point is how to select and apply an accounting policy when a specific Ind AS is not available on a particular transaction. Suppose you come across a particular transaction, correct? Now let us say no particular Ind AS right now, because Ind AS are still in the developing phases, correct? Lot of what we call work is still going on, and that's why we are seeing so many times Ind AS even are getting what we call replaced. For example, recently as we have seen Ind AS 17 has been now replaced by Ind AS 116. So lots of revision work is still going on. It is not yet foolproof. Now suppose I come across a particular transaction and suddenly I find myself in a quagmire. Quagmire means in a virtual dilemma, correct? Because no particular Ind AS is there and I am not in a position to what we call apply an accounting policy. How to select and apply an accounting policy when a particular Ind AS is not available on a particular transaction? So I have already given the answer. Whenever you are going to select an accounting policy towards a particular transaction, the basic intention should be that you should give a faithful representation of the things, which we call it that the information should be absolutely relevant and it should be reliable. Is it clear to you? So management should use its judgment in applying an accounting policy that results in information that is relevant and of course that is reliable. Is it clear to you? Similarly, the next, because these are the points which so often I have seen that students superficial things they do, but the point at this level which we need, sometimes we tend to ignore, correct? Now the next point here is that consistency of accounting policy and changes in accounting policy. I will put up this sheet here also, correct? Consistency of accounting policy and changes in accounting policy, and each one of you know. As far as consistency of accounting policy is concerned, it is quite natural that we need to be consistent. Correct? Right from class 11th, we have been studying the what we call concept of consistency, which states that once the policies which you have adopted, each year you should try to actually go on with those policies, because unnecessary changes could make the comparisons what we call impossible, almost very difficult. So entities should select and apply the accounting policies consistently for similar transactions. That means we should not make chip chop, what we call chip chop changes. We should not chop out what we call old policies, put up and replace them with the new ones, because as I have already told you, it is going to bring many troubles otherwise. So entities should select and apply accounting policies consistently for similar transaction and events and conditions, unless it means the general rule is that the entity should go on with the similar type of consistent policy, similar type of accounting policy. They should be absolutely consistent. However, sometimes we are forced to make the change. So that is why I have written, unless the change is required by a particular Ind AS, or when we think that by bringing about this particular change, the financial statement can provide greater reliable information and more relevant information. That means under these circumstances, we can effect a change in the accounting policy. However, as far as possible, we should not alter, we should not change, we should be very consistent with respect to accounting policy, and especially with respect to the similar transactions. However, we can change the policy. In fact, I would say that we shall be forced to change the accounting policy if there is a change in the relevant accounting standard itself, or there is a change, or when we are of the opinion that by bringing about this particular change, we can present the what we call financial statement in a more relevant manner and more what we call faithful manner. Correct? This is sheet number 2, and no one should demand what we call any notes for the same. I have been telling you, these are handwritten notes, these are class notes which you need to write off your own. Correct? So now, following are not changes in the accounting policies. Sometimes we get confused by this particular fact, whether it is a change in accounting policy or not. So following are not changes in accounting policy. You need to understand that. Correct? Application of an accounting policy that differs in substance from those previously occurring. Suppose I have made a policy for a particular transaction, and now I have made another policy for that particular transaction, but the point here is that why I am making the different policy, because the circumstances are different. So standard says that whenever you are going to apply an accounting policy and which differs from the previous one, just because of the fact that conditions are different, it should not be considered as a change in accounting policy. We will have a look over some examples also later on. Similarly, when we are going to apply a new accounting policy, because it is a new accounting policy, it cannot be considered as a change in accounting policy. So we will have a look. This was sheet number 2, which I will keep here. Now we come over to sheet number 3. Correct? Now in this sheet, I will write here case study 1, so that later on it becomes easier for you. This is your case study, correct? This is case study, and in this case study, what I have written, as in fact all the case studies have been what we got taken from the professional bodies modules, correct? So needless to add that, but some case studies are framed by us also. SQ Limited has classified an owner-occupied property as investment property. SQ Limited has classified an owner-occupied property as investment property. First of all, you need to understand what is an owner-occupied property and what is an investment property. In fact, these two terms we have discussed at great length in Ind AS 40. But I will recap it. Let me have a sheet first. But the problem is that, as you know, I'm recording these sessions from my house itself, and that is the reason. Okay, just wait, just give me a minute or two. Let me actually search out a blank sheet. Here I have got, fortunately, and let me pull it out. Correct? It's the makeshift studio, and that is the reason. Here I have got, fortunately. Correct? Before I dwell upon this particular question, let me explain actually what is an owner-occupied property and what is an investment property, because so many questions are there with respect to these two terms. And see here, What is an owner-occupied property? I have already told you these two terms have been covered at great length under Ind AS 40, which deals with investment property. One is owner-occupied property and another one is investment property. What is owner-occupied property? An owner-occupied property is one which are held by the owners, but I do not want to confuse you here because that we have discussed under Ind AS 40. Owner-occupied property doesn't mean that only the real owner is having that property. That property could be held by a lessee also, but here you just simply do not confuse yourself. You simply think that it is an owner-occupied property, whether you consider it as real owner or whether that property is in the hands of a lessee. Correct? An owner-occupied property is one which is held by the owner for the purpose of what? One, production, for use in production, number one, or for use in supply of goods and services, use in supply of goods and services, or third, for administration purpose. Then we call it as an owner-occupied property. I have already told you owner-occupied property could be in the hands of the real owner or it could be in the hands of the lessee. But if the real owner or the lessee is using this property for any of these purposes or for all these purposes, that will be termed as owner-occupied property. Number one. Number two, what is an investment property? Name itself is giving you some idea. Again, this property, correct, could be in the either could be in the hands of the real owner or it could be in the hands of the lessee. But if the owner or the lessee are holding down this property with an intention to earn rental incomes, or for capital appreciation purpose, that means they are holding it, they are going to hold it for a long period of time so that there is capital appreciation and they get great benefits. Is it clear to you? I hope you got the difference between owner-occupied property and investment property. Now we come to this question. Now you will be able to understand it. So owner-occupied property is one which is being used either for production or which is being used for in supply of goods and services or for administration purpose. On the other hand, investment property means property held for the purpose of what we call either earning rental income or to earn capital appreciation. Now in this question, what is happening? SQ Limited has classified an owner-occupied property as investment property. That means SQ Limited was having a property. Earlier it was owner-occupied because SQ Limited might be using this property for any of these purposes. That is why they had classified this property as owner-occupied property. Now let us say from the current year they might have what we call changed their intention, and let us say now they want to hold this property for earning rentals or for capital appreciation. So in the light of Ind AS 40, they will have to now classify this property as investment property. So question has basically given this particular information that SQ Limited classified an owner-occupied property as investment property. Because earlier this property was owner-occupied property, question states that it was being measured as per revaluation model, because owner-occupied property could be measured at cost or could be measured as per revaluation model. Correct? Any property which is owner-occupied property, it could be measured either at cost or could be at revaluation model. It's a choice which is given to the entities as far as owner-occupied property is concerned. But Ind AS 40, which basically deals with investment property, states that investment property can be measured only at cost. So what is the question now? Now we'll be in a better position to understand the question. So SQ Limited has classified an owner-occupied property as investment property, and it was being measured what we call as per revaluation model. Now the question is asking us, can entity do so? That means now this property has become investment property. So can we still what we call use the revaluation model? I have given you the answer. No, we can't. No, Ind AS 40 permits only the cost model. So entity will have to measure it at cost. Is it clear to you or not? Then that means entity will have to change its accounting policy from measurement of revaluation model to measurement of cost model. That is the point here. That is why this particular question has been given under accounting policy. Now case study 2, just have a look over here. Entity 501 Limited acquired a building for its administrative purpose. There is an entity acquired a building for administrative purpose and presented the same as property, plant and equipment in the financial year 21-22. They acquired this property for administrative purpose, and just a moment I told you, it means it is an owner-occupied property. This building will be classified as owner-occupied property, and owner-occupied property simply are presented as property, plant and equipment in the balance sheet. During the financial year 22-23, entity relocated the office. So what happened? Now they changed their office and entity relocated the office to a new building. Now they have gone to a new building. That means they have now left the old building, the earlier building, and leased the said building to a third party. Now earlier building which they left, please try to understand this way. It is given that entity acquired a building first. Because this building was being used for administration purpose, that means this particular building was owner-occupied property. And it is also given they have classified it as property, plant and equipment in the financial year 21-22, which is not wrong at all. But now in the current year, which is 22-23, in this current year, what happens? They shifted their what we call office to a new building. Because they have gone to the new building and they have left the old building, and question has given that old building now has been leased out. If you have leased out the old building, that means the old building will no more be owner-occupied property. The old building now will become investment property because now your purpose and intention has changed. Intentions have changed. Because earlier the intention is to use it for administration purpose, and now the same building has been leased out. That means your intention has gone from what we call these to the rental, or what we call for having more capital appreciation. So this will be reclassified as what we call investment property. You got the point. First of all, you need to understand the question. These are rough sheets. Let me come to the main sheet now. So Entity 501 Limited acquired a building for its administrative purpose and presented the same as property, plant and equipment in the financial year 21-22, and during the financial year 22-23, entity relocated the office to a new building and leased the said building to a third party. That means now this building, old building, correct, is no more owner-occupied property, and this building has now become what? Investment property. Following the change in usage of the building, that means the old building, entity reclassified it from PPE, because owner-occupied property is classified as property, plant and equipment. So they have now reclassified it from owner-occupied property to investment property. Should entity now account it as a change in a policy or not? But the point here is that this is not exactly change in accounting policy. Correct? Why it is not a change in accounting policy? Because standard says, this is your answer also, a change in classification of a building, a change in classification of a building from PPE, that means from owner-occupied property, to an investment property due to change in purpose. This is due to change in purpose, correct, for which it is held by the entity, is not a change in accounting policy. That means whenever we are going to adopt something new, because of change in purpose, that cannot be what we are considered as a change in policy. But the point here is that now it will become an investment property, no doubt about that. Is it clear to you? This was your sheet number 3. I hope you have written, or in fact, you pause the screen, then write it, or write each and every word. This is sheet number 3. Now we move over to sheet number 4, correct? In the sheet, what is given to us? How to apply the changes in accounting policy. How to apply the changes. Still we are moving with the topic accounting policy. In fact, this is the first section, you can say, of this particular standard. This is sheet number 4 now. How to apply the changes in accounting policy. There may be tools, and this is very, very difficult, very, very tough part. It is not easy. It is there are lots of complications involved in it, so you have to be extra careful. Correct? How to apply the changes in accounting policy? Whenever we are going to apply the changes in accounting policy, it is easy to go for the change, but its application and its accounting is pretty tough, especially in the light of Ind AS guidelines. So we need to pay attention hard. Two situations are there. One is change in accounting policy is due to new Ind AS. Sometime what happens, let us say I'm following an accounting policy with respect to a particular transaction. Now a new Ind AS comes and it actually gives some guideline which is different from the one which I am following. Because earlier that Ind AS was not there. It is a new Ind AS. So whenever accounting policy is changed due to advent, due to introduction of a new Ind AS, in that case, to be very honest with you, we do not confront any problem. The reason being is that when an entity will change accounting policy, change in accounting policy due to new Ind AS. So whenever we are going to change the accounting policy due to introduction of a new Ind AS, in that case the guidance will be provided by the Ind AS itself, that how you are going to effect the change. So generally under such circumstances we are not going to confront any problem. Then when the problem will apply, under situation 2, there are two situations. One is change in policy due to what we call new Ind AS, and when this is the second situation, when an entity changes accounting policy upon initial application of an Ind AS that does not include any guideline, or when an entity changes accounting policy voluntarily, then the entity will have to apply the retrospectively. It indirectly, the second point states that whenever you are going to apply a change in accounting policy, because now you are first time adopting the Ind AS, because Ind AS it's a recent phenomena. In fact, from 1617 companies have started following it, isn't it or not? And that is the reason actually it's a recent phenomena. So quite obviously earlier we were following the existing accounting standard, and suddenly now we try it and we move over to Ind AS accounting. Then quite obviously there were some accounting policies which we may have to change, because those accounting policy may not be similar as far as guideline is concerned under Ind AS, isn't it? So under second circumstances, when an entity under second circumstances when an entity will follow the what we call accounting policy, because entity is going to apply the Ind AS first time, and at the same time an entity sometime can change the accounting policy voluntarily. Correct? So under such circumstances, how to apply the change? We are going to apply the change retrospectively. That is very important, retrospectively. Because whenever the word retrospective means from the past, prospectively means from in future. But whenever the application will have an effect retrospectively, it becomes a pretty difficult task. It is not an easy task. Neither it is what we cup of coffee, not it is a stroll in the what we call park. So we are going to, of course, dwell at great length as far as retrospective application is concerned, but that will be done in the upcoming session, because it will require huge amount of efforts to comprehend this particular topic with this sort of facilitation which we are used to. Correct? So that is the reason actually I am talking about. This particular part is very, very what we call important, not only from the point of view of your examination, because so many times when you are going to later on enter into your practical arena, over there you will require knowledge regarding the retrospective application, and there are very few efficient professionals today who are very well deft in it. So that should give you great zeal and enthusiasm to understand it properly. That we will discuss in the next session. So till then, it's a short goodbye.